Hi, and welcome to this week's market presentation.
Latest news.
Starting with the latest news, trade tensions between the US and China appear to be easing down following the meeting in South Korea between President Trump and President Xi. During that meeting, the US and China agreed to a more comprehensive trade deal that will see reduced tariffs on Chinese imports into the US. And in exchange, we'll see China pausing and delaying the export controls it put in place for rare earth minerals, as well as agreeing on purchases of US agricultural products. This will extend the truce between both countries by a year. And although it is not the comprehensive trade deal that some had hoped for, it has certainly eased tensions and reduced the prospect of a prolonged trade war that hurts both each of their countries' economies and the global economy as well. Equity markets rallied on the removal of the short-term risk catalyst for the global economy, as well as for the temporary stability that economies have gained as a result. Oil demand outlooks improved due to the subsiding risks regarding economic pain. And lastly, the impact of this quote informal framework will certainly depend on the extent to which each government believes the other is upholding its committees. However, there is hope that we'll see a positive result from these trade negotiations. Moving on to crude oil markets, more specifically, OPEC Plus announced it would be pausing additional production quota increases in the first quarter of 2026 amid the ongoing expectations of an oversupplied crude oil market in 2026. Nonetheless, the OPEC Plus group did announce a modest increase of production quotas of 137,000 barrels per day for December. This will be the first interruption to the ongoing monthly hikes that began this past April. The ongoing oversupplied expectations for the market, however, will remain, especially given the almost 1.4 billion barrels of crude oil that are currently floating at sea, the highest levels since 2016. The impact on markets is likely to lead to a stabilization in crude oil markets, at least in the short term. But once we get into the first quarter of 2026, as the oversupplied conditions remain, we could see further downside to crude oil prices globally.
Weather.
Moving on to the latest weather forecast, we see favorable weather conditions being forecasted across most of Europe over the next 7 to 10 days, with temperatures expected to remain above the seasonal average. This is most prevalent at the beginning of this week, with temperatures as high as 6 degrees above the seasonal average in Northern Europe. As we move through this week, temperatures will ease off from those highs, but nonetheless remain above average. Expected precipitation is expected to ease throughout this week compared to the last couple of weeks, but nonetheless, we're still forecasting precipitation, particularly in the Nordic region at the beginning of next week. In terms of average wind speeds, they're following a solid week of wind speeds over the past week, which helped wind power generation. Wind speeds are expected to ease off over the next 7 to 10 days. Lastly, as we near the very end of the hurricane season, we no longer see any tropical activity forecasted over the next week, easing any concerns, particularly regarding US LNG exports to Europe.
Macroeconomics.
Macroeconomic figures were released for China for the month of October, with the PMIs showing a contraction in the manufacturing sector, with a PMI value dropping by 0.8 points to 49, and indicating a potential contraction in the Chinese manufacturing sector. Still unclear what the causes of the drop is and how much the ongoing trade tensions with the US are fueling the decrease in manufacturing activity. In terms of the service sector in China, we see a pretty stable evolution, with the PMIs still hovering at around the 50-point level.
Crude oil and LPG.
Global crude oil prices saw a relatively stable price evolution over the past week, with prices moving less than 1% on the week. Prices for WTI remain hovering around the $60 per barrel price level, with Brent crude oil prices around the $65 per barrel price level. Overall, we continue to see the U.S. sanctions on Rosneft and Lukoil impact some tightness in the supply outlook, although it remains to be seen how effective the imposing sanctions will be. We are continuing to see signs of Chinese and Indian buyers moving away from Russian oil, potentially indicating a move towards Middle Eastern supplies that could see additional tightness to crude oil prices. On the other hand, looking at some of the bearish pressure in the market keeping prices from rising further are the continued expectations of an oversupplied market in 2026, and as I mentioned earlier, the record level of barrels floating at sea currently. Lastly, we've seen an increase in U.S. crude oil output to a new record high of 13.6 million barrels per day, easing up some of the supply concerns.
Natural gas.
Looking at natural gas prices next, we see a slight decrease over the past week, pushing the front-year pricing for Cal 26 down to just over 30 euros per megawatt hour, with a nearly 3% drop on the week. The decrease was more pronounced in the first quarter of 2026, decreasing by 3.4% on the week. Overall, we are seeing a relatively stable price evolution over the past few weeks ahead of the onset of winter. Looking at European gas storage levels over the past week remain stable at around 82%. Looking at the storage injection and withdrawal rate, we see a level of still net injections into storage, although quite limited, just in positive territory. This is in line with the levels that we were seeing last year and the average since 2012. Now, the warmer temperatures over the past few days and forecasted for the beginning of this week could keep the storage injections in net positive territory, keeping storage levels around that 82% level, at least throughout the beginning of the week. Looking at total supply and demand there, we see a drop in total demand from the high that we saw about a week and a half ago, largely due to the more favorable weather conditions. In terms of supply, we've seen that continued gradual increase, and over the past week, we've seen a further improvement there, with total supply figures ahead of last year's levels and in line with the levels we were seeing in 2022 and 2023. The improved supply picture for natural gas has been due to a slight uptick in LNG sendouts, as LNG imports continue to increase, now surging to a 7-month high, in part due to strong U.S. deliveries. Norwegian gas flows, on the other hand, have remained relatively stable at around 300 million cubic meters per day. Looking at global LNG export destinations, we continue to see the increased share going to Europe in expense of Asian consumers, which are seeing lower shares of total exports than in previous years. One important factor to mention regarding LNG exports globally has been the appearance of the first sanctioned Russian LNG vessel switching cargoes with another vessel in circumvention of the existing tariffs, potentially highlighting the difficulty in enforcing those tariffs and ensuring that Russian LNG exports have continued not as impacted as previously felt, loosening supply expectations. Lastly, in discussions between President Trump and Japanese Prime Minister over the past week, Japan signaled that it would find it difficult to move away from Russian LNG imports currently, signaling a slower reduction in those imports, at least over the coming months and year, further adding to some bearish sentiment regarding global LNG exports. Looking then at TTF investment fund positions, we see a level of slightly net long positions, but nonetheless, we continue to see short and long positions increasing over the last few weeks and months, signaling some degree the uncertainty amongst market participants and the stability that we've seen in pricing, showing still unclear whether we'll see further bullishness or bearishness in the coming weeks and months.
Coal.
We look at the price evolution with a slight increase over the past week. European coal prices have risen now to a 2-month high on winter demand preparations, and we've also seen a surge in European thermal coal deliveries by a 50% increase month over month to a 6-month high of 2.1 million tons. On top of that, on the supply side of things, we are seeing a slight disruption to US and Colombian coal operations, reducing some of those supplies going to Europe currently. On the bearish side of things, however, keeping prices on the lower end that we've seen over the last few years and limiting the upward movement in the market in Europe are the strong wind output and mild temperatures, limiting demand for coal from the power sector in particular. Additionally, the rising carbon prices, as we'll see later, are also promoting additional coal to gas switching, further reducing demand for coal in the continent. Lastly, ARA terminal inventories remain at the highest since mid-May of this year at 3.92 million tons, which given current demand levels is more than ample to meet demand expectations.
EU and UK emission allowances.
European allowances have remained on the higher end over the past week, increasing ever so slightly on the European side by around 0.3% and jumping up 3.1% on the UK side of things. Overall, markets remain bullish with the outlook for tighter EUA supplies starting in 2026. On the UK side of things, the anticipated linkage of the EU and UK markets continues to add support to UK prices. Additionally, when we see slight dips in the price of European allowances, especially when they approach the 77 euro per ton level, we see strong dip buying activity, further solidifying those prices to remain at higher levels. Big intraday move seen today with EUA prices reaching an 8-month high, moving above the barrier of that $80 per ton price level. Overall, when we look at the emissions, however, we see some reasons to be somewhat bearish on current pricing, given that emissions, especially over the last week with the surge in wind power generation, were pushed to the lowest levels over the past 5 years. And year to date, power sector emissions do remain near the lowest levels we've seen over that period of time. Nonetheless, investment fund positions remain near record highs, with the level of long positions on the European side at the highest levels we've seen. On the UK side of things, we see similar levels of record high long positions.
Electricity.
Looking then at electricity prices, here we see limited movement over the past week with just a slight downward trend over the past week when we look at the forward years, with the front year coming down around 0.5% week over week and the forward years coming down around 0.8% on the week. We see a similar trend across other key European markets, particularly looking at Poland and Italy, with a relatively stable price evolution. And then on the other hand, we do see some slight bearishness, particularly looking at the French power market, with the front-year power price in France dropping to an all-time low. Over in the Nordic region, the greater levels of precipitation over the last couple of weeks has also added some bearish sentiment to Nordic power prices. Looking at total demand and residual load, we see the impact that the surge in wind power generation has had on residual load, pushing it to the lowest levels over the past 5 years, while total grid demand has remained in line with last year's levels, slightly below the past 5-year average. Looking at the European supply mix, we see that French nuclear power generation remains in line with last year's levels, even as we do see some extended outages announced by EDF and multiple nuclear reactors, although some of these outages have been announced to be strategic decisions to save fuel, given the high renewable output and lower demand we are seeing currently due to weather conditions. Looking at renewables and fossil fuels, we see that surging of renewables to a record high for this time of year and the corresponding dip in fossil power generation, primarily through a decrease in gas-fired output. The surge in renewables was very much driven by an uptick in wind power generation, given that both hydro and solar have remained in line with previous years. Looking at fossil generation, we see that it dipped from near the highest levels over the past 5 years now to near the lowest levels over the past 5 years. Similarly, looking at coal-fired power generation, we see it similarly weak compared to past years. Lastly, looking at the guarantees of origin, we see a further bearish price evolution here with sharp decreases across the board. Prices for year 2025 production came down around 20% on the week, with similar sharp decreases further along the curve. Overall, when we look at the cumulative renewable generation in AIB countries, we see total output this year. It's just slightly below the level we saw in 2024 and notably above the previous year's levels. When we look at the difference by technology, we see the record high levels of cumulative solar power generation and the less improved output for wind and hydro, especially hydro, due to the dry weather we've seen this year weighing on output. Nonetheless, expectations for guarantees of origin are for strong supply outlook through the end of the year, adding to the bearish pressure on the market. That covers this week's market presentation. Thank you for joining.